And live at the Chicago Board Options Exchange is Matt Schapiro of MWS Capital, who has over 15 years of experience as an options trader and money manager. Also with us is Ted Parrish, Principal and Director of Investments at Henssler Financial Group. Ted helps manage $1.2 billion and says he's holding on to his positive views for the end of the year and staying fully invested in this market. And Ted, because of that, I want to start with you. You know, we've been talking a lot about the sort of tepid trading this week. Are things basically on hold until you get the big number on Friday, the unemployment number?
I think the Friday's report is very important. You know, we've been really anticipating some job growth, which for a while there we were getting, and then after the census employees were let go, the last number was really negative. So yes, it's a big report. I think that we've seen a lot of negative data, and you know the expectations are for some more negative data this week. So hopefully Friday is a good number.
What's the likelihood, though, in your view, of it being a good number at this point?
I think it's pretty good. I think that some spaces within the industries in the S&P 500 have actually added to payrolls, and that's pretty evident. If you look at the temporary employment data, it's been trending very positively, and the CEO surveys have all been pretty positive. So I think that the number will be over 100,000 at least on Friday.
You know, Ted, it's Dominic here. The idea about the jobs number, though, I mean, there are still analysts out there who are expecting, quite a number of them, that the number is actually going to be negative. What makes you think it's actually going to be positive this time around?
Because at a certain point in this cycle, companies have to hire, especially the companies that want to keep up and actually grow. And I think that we've seen capacity utilization in the industrial segment actually grow by 1% in the last report. That means that they have to hire, and I think companies have. I might be a little optimistic, but I do think that companies are going to hire, especially good companies. They cut a little too many people this time around. I think about 3% too many people. Of course, some of the layoffs are structural, and you know some of the jobs aren't coming back until real estate comes back. But you know, I think that some of the core industries that are actually seeing increase in activity need to hire.
Group. Ted, let me ask you, because you are among the more optimistic folks that we've talked to as of late. Where are you getting your optimism at this point?
Well, you know, I have to understand the type of companies that I'm buying. We're buying S&P 500 companies, only the highest quality S&P 500 companies, and the earnings cycle has just been really robust. And you had a guest on earlier who said he thought that the estimates were actually higher than what he thought they were going to come in at. In other words, they were overestimating. I think he's wrong about that. You know, if you look over the past 3 months, the numbers have gone up for S&P 500 companies in 5 out of the 10 sectors. So I think the numbers are probably going to be better than what everybody's expecting. That's the main reason we think the market's going to be higher. And number two, I think the market's really cheap right now. The large cap companies, the S&P 500 versus the smaller cap companies, there's a huge discount there. So we think that investors are going to realize that soon.
I want to jump in here and let Matt Schapiro sort of take the other side, because I could see him kind of snickering. And Matt, you're a trader down there. We're below the long-term average. Are you playing it? Are you an optimist, or are you playing this from the short side? You're selling rallies. How are you going here?
Well, in the VIX, it looks like the professional traders want to play this market to the short side. And, you know, I do agree with Ted on the fundamental picture is very strong for U.S. companies. Unfortunately, the economic backdrop, we seem to have some weakness in the poor employment picture and a poor housing picture. Now, in the VIX, you've seen right now the market is sort of at these correction lows, and the VIX cash has settled down quite a bit, Matt. Unfortunately, in the pit, all the VIX futures are way over 30. And they're extremely sensitive to even the smallest move in the S&P 500 or the Dow Jones. So there's still tremendous disquiet out there, and I believe much of the hot money is playing for continued downtrend in the market.
And Matt, this is Brennan Lothrick. Can you also talk about the technicals? Marianne Bartels from Merrill Lynch came out and said, look, the NYSE Composite Index has already shown a dark cross, which is a 50-day moving below the 200-day. The S&P very close to that. That is not portended well for future returns for the S&P. Is that what you think as well, technically speaking?
Well, I think that is what is behind really where these VIX futures are. The VIX futures do not like this level in the market, even though we're just placid here seemingly under the surface. Even a 10, 20, 30-point move in the Dow Jones, these futures jump at least 50 cents.
Matt, it's Dominic here. Speaking of, I don't want to harp on the technicals here, but let's take a look at this really quick here. A lot of people saying that in this market, especially with the S&P 500, we talked about this relationship or correlation to the euro for a long time now. Now it seems, we heard from Julie, that it's correlating to the yield on the 10-year note. I mean, are traders down there saying that if we keep on seeing slides in the euro and slides in the yield in the 10-year, that we could keep on seeing slides in the S&P 500?
Well, there's tremendous risk aversion. Realize you're getting, like Ted says, 3% dividends in solid blue chip stocks. That's what I do with my investors. But there's so much risk aversion, people would rather lend to the government at 3% than buy high quality companies and pocket that 3% dividend.
Ted, let me ask you, let's get back to the economy here. What makes you a bear on the economy? What makes you a bear on the jobless situation? Because the number obviously last month wasn't great, and if you get a loss this month, it's just not going to really make the markets feel so good going into a long weekend, is it?
Well, if I knew for certain that what the number was going to be, I would leverage up, which we can't do, by the way. You know, it's possible that the number is going to be negative. The economy, I mean, housing is bad. Now, those are things that we know. But what happens when we have a good month? What happens when we finally get, you know, the buyers back in the housing market? I mean, it's going to happen.
You know, wait,
and it's probably going to happen this year.
I got to jump in here because I got viewers emailing me, and they're saying, and they're responding to kind of some of the optimism that you've got, and they're saying, where to begin? What about all the economists now who see much evidence of tepid job growth for a long time? We're not saying that in a year we're going to be creating 700,000 jobs a month. I'm a little lost about where all your optimism is coming from. Growth
builds jobs. I mean, these companies are growing. I don't think there's any argument that the S&P 500 companies are not growing their earnings. We're seeing expansions in some of the bigger, better companies, the companies that want to be in a position to take advantage of a growing economy and an expansion.
Come on, Ted, you know there's a lot of cash that they've got on their balance sheet, but they're afraid to put it to work. I mean, Matt, what do you think?
Yeah,
I mean, companies are hesitant out there, right, to hire.
Well, they really are, and one parallel, actually big picture, is we seem to be stuck in this marketplace, an analog to 1967 to 1980. We've now had, 12, 15 years of basically the Dow Jones Industrials at 10,000. So, from Ted's point of view, I think we can break out of it over the next couple years, but look at how touchy the market is. So I think at best...
Next couple of years.
At best...
That's the long run. We're all dead. A couple years.
At best, we're in the 7th, 8th, or 9th inning of this decade-long period of poor returns like we had in the 70s.
I wonder what...
there has to be...
Go ahead, Ted.
There's demand out there. I know you're going to pick at me for using this example, but look at the Apple computer and the iPod sales. I mean, the iPhone sales. I mean, if you build it, they will buy it if they want to. I mean, consumers are spending money on what they want to spend money on. It's just not the typical recovery.
But they're not borrowing any money, right? They can't get loans. They're not going to be buying houses. A lot of people are looking at a double dip in housing. Do you expect that to come?
That's possible. But I can tell you this: if the Fed raises rates and squeeze the net interest margins of the banks, they'll start lending that money because they have to. That's going to happen really soon.
Matt, I got to get to you on this one here because, this optimism versus pessimism argument here has been holding out for a while. A lot of traders saying the catalyst is going to be earnings. Do you expect earnings next quarter to be as good as everyone says they're going to be?
Well, I think they should be pretty good. Most of these companies have been able to adjust very well to the economic backdrop. So their earnings power relative to almost no inflation and very low very low interest rates means that they're very attractive. The problem is the sentiment is so bad in a marketplace that's dominated by short-term trading, where again, traders want to be short this market and take the 10-year Treasury yield at 3% rather than invest in these blue chip companies for a 3% dividend.
I wonder, Matt, what do you think about, Ted talks about earnings, and a lot of the optimists do bring up earnings, but I just got a message from Michael McCarty saying earnings don't matter when stocks are for sale. That's why the VIX remains where they are. We've heard this from a lot of people today, including a Bloomberg story studying the technicals here. How much does it really matter?
Well, I think in this marketplace, without that long-term economic conviction behind investors. The investors have fled. They're kind of hunkering down, and we have a market dominated by short-term traders where these VIX futures are extremely jumpy. As I said, even in the tiniest moves in the S&P 500, it's as if everyone's just waiting for that next shoe to drop in the next couple days.
All right, guys, we got to leave it there. Hey, Matt Schapiro, thank you so much. Ted, I wish we had more time. You were a good sport. I know we beat up a little bit on you, but
you did. I have some stuff for you next time.
All right, well, we'll bring you back. All right, Ted Parrish and Matt Schapiro joining in our markets team right here in studio. We're going to take a break here.